Hey everybody, Marty Mazur. Good afternoon. March 31st, end of the first quarter, 2016. Wanted to talk at you for a few minutes and then quickly run through the charts. Interesting stuff going on out there. Very interesting market as well. There's too many angles to approach it from to do it justice in the amount of time that I would ask you to commit here. So I'll have something more substantial over the weekend, I'm sure. But I thought I'd do something I haven't done yet. With you, I'm going to read right from my own log. I keep a daily log. I don't necessarily write in it every day, but generally several times a week, where I just kind of I'll just record my thoughts about the market and how it's acting and so on. And yesterday I did this, and I talk about what I call the present market regime. So I want to set the stage with just reading what I wrote yesterday, and then adding a little bit to that, and then showing you the charts. So here we go. The present market regime, in my view, is a lot about the Fed and somewhat about commodities, i.e., oil. Yesterday's rally, and this would have been day before yesterday, occurred despite a decline in oil. In my view, the data will come in better than expectations, and that would be the economic data, which under the present regime would not help the market in the near term. It'll bring on Fed fears and become a headwind for the market. Now, Q1 earnings are going to be bad. The question is, have prices already discounted them? And therefore, will we see bounces on beats, on earnings beats? And then I wonder if that trade isn't finally worn out. Buybacks may not be enough going forward. We got to see revenue gains, and I can't emphasize that enough. Now, the weaker dollar could help a little in terms of first quarter earnings because it was weak during the quarter, or a lot. But we got to see an output pickup. Now, the last durable goods numbers were discouraging from a capital expenditure standpoint. However, the reading just before that was pretty encouraging, and this week's trade numbers showed increases in cap goods both on an import and export basis. And folks, what I mean by that is companies are squeezing profits out of existing capital. And capital would be the resources they have with which to generate their products. And in a good economy, in a good expansion, we need to see a good amount of capital investment. And what that leads to is enhanced productivity. And we need that badly at a time when labor costs are now, I think, rising at a noticeable clip. And I say that all that said, with regard to earnings, guidance may be good. So this would be, how do you feel, talking to the company, how do you feel about the quarters going forward? And I think the presumption is that if the dollar is going to stay low, and I'm going to show you a chart in a second, I think we could get surprisingly good guidance, despite the fact that we've got a Great Britain referendum and a U.S. election coming up. So there's both good potential and not so good potential there. One huge bright spot, and I keep emphasizing this, and something that has to make most people intermediate term bullish, and that's breadth. And this is as of yesterday, 93% of the S&P 500 is trading above their 50-day moving averages. All sectors ex healthcare were 90% above last week. That's an exceptionally strong reading, and that's something that's been rare of late in this bull market that we've been in. So that's enough of that. That's kind of my narrative in terms of my feelings on the market. So as you can tell, I'm kind of in that camp right now that says really good economic news may not be good news for the market, because what I'm seeing is that the market gets nervous about the Fed. This rally that we've had off of the Fed meeting, I think, confirms that. Okay, let me just go ahead. And before we get to the chart that you see there, I want to pull over another one. And let me just for effect. So the other day I showed you the Citigroup Economic Surprise Index and the dollar, and showed the negative correlation, and said that the dollar, or I should say the Fed, sees the dollar as a headwind, and therefore, despite the better than expected economy this year, they talked it down because they don't want to raise interest rates and potentially exacerbate what was a real bull market in the dollar. So the mountain chart, the white line that you see in front of you, that's actually the dollar. The green line is the S&P 500. And I think this explains a lot of what we've seen. You notice the S&P off that February low. You see the dollar trying to hang in there. You see the dollar kind of collapse, so to speak, and you see the S&P moving higher. Now, up until recently, we've been talking mostly about oil. And that's the purple line, West Texas Intermediate. You can see, wow, just the very, very stark or very extreme correlation between stocks and oil just up until recently. And this is where the Fed took over. Despite the lower dollar, oil has come down as well, and that's on production cuts and this meeting that between OPEC and the Russians that may result in a commitment to a production freeze. Many skeptics, I'd probably be one of them with regard to that meeting. But notice the stock market was able to kind of get away from oil for a while. I do think if oil comes careening back, you're going to see that correlation maybe come back. So as you can see, folks, I'm pretty cautious in the near term. So if the dollar gets stronger, that could be a headwind for the market, but I'm not in a strong dollar camp as it relates to this year. I do think it'll be volatile like stocks are. I do think it'll be going up and down, but I think the dollar rally has probably seen its best for a while, and that's just my observation. So let's look at the stock market. This is that one-year chart. It's been quite the rally off of February 11th. You're really going to like your March statements. Notice we have this downward sloping trend line, and notice the last couple of days we just could not get there. And interesting how that has been some really tough resistance. The S&P was down 4 points today. I talked the other day, I think it was, about on-balance volume. So this measures basically the legitimacy of a move from a volume standpoint, meaning the movement or the direction that garners the most volume says the most about the ultimate direction of the market. And particularly when we're moving up, you want to see up moves on high volume. Gravity can bring a market down on low volume, but to really see something substantial to the upside that's lasting, typically, you want to see that volume go up. So you may notice, without drawing a line here, this kind of slopes down a little bit, this on-balance volume, which suggests that there's been greater volume to some degree or slightly greater on the down days, while during that period the market goes up. So that would be a red flag to a technician. Also, the moving average convergence divergence line, which sums the 26 and 12-day moving averages, and then there's a 9-day moving average of those, and I know I'm getting technical, but this is a real good momentum indicator. Remember we talked about here where it was sloping up even though the market was straight from there to there, and that really was a good signal that the market was going up. I've been telling you this has really been flattening out. When the MACD line, the white line, goes below the signal line, that's a signal, a bearish signal that there could be a sell-off coming. It's stubbornly, just barely staying above there by 0.29. So that's a red flag that I'm looking for. So I remain somewhat bearish on a very near-term basis. Now, here's the argument that suggests I'm very wrong, and that would be seasonality for one. April is historically the best month of the year for the market. There is high short interest right now, meaning a lot of people have been betting that it's going down, and if this continues, those shorts are going to have to cover or just get utterly killed, particularly if we really penetrate this resistance level and it looks like we're going to gain some momentum. Hedge funds are having another miserable year so far, so if they feel like they need to get in on the long side, they could push the market higher in April as well. Plus the retail investor, your average folks who maybe perhaps are trying to do it themselves or what have you, they appear to be coming back to the market and maybe in a big way, and they tend to as the market goes up. So there is a very legitimate case that these signals are going to prove to be wrong right now, or going forward, at least through April. When we get into May and we get closer to the issue in June in Europe, then we'll have a whole nother conversation. So folks, here's my point. Look for volatility in this market going forward and get comfortable with it. This is just going to be an unusually volatile year. I've said this 1,000 times over the last 30 years. Down markets for long-term investors are very, very good things. The market, the stock market, is one of those things that actually benefits from stress. In a stressful situation, when stock prices go down, that's when the weeds, if any, are pulled. That's where efficiencies have to be gained. That's where we see companies do smart things. When it stays up for a long time and doesn't consolidate and doesn't have any meaningful corrections, then stupidity begins to reign and hubris and overconfidence, and that's where problems exist. So even though you could probably draw a straight line back 2 years, and the market is, in fact, I know you could, the market's about where it was. So it's been a real rough 2 years. It's a consolidation period. If you're a long-term investor and your horizon is more than 2 years, you're not going to worry about how 2016 plays out. I'll say this, on the bullish side, if we can get some good gains in productivity and we can see some revenue growth, if the dollar stays relatively low, if we don't get any huge international surprises, we could get some multiple expansion. We could see the market rise in that event, and I think interest rates need to stay low as well. So that's a scenario, and a legitimate scenario that a lot of bulls are clinging to. If we don't see gains in productivity this year, if the market stays north of 17 times earnings, and then the economy begins to show some signs of life, and it looks like the Fed's going to raise interest rates, then it becomes a rough year this year. I think I just kind of sit on the fence and look and say, I think both are legitimate arguments. In the very short term, you would think at these overbought levels that we're going to see some stress to the downside, but remember what I said just a couple minutes ago about seasonality and all these other factors. These technical indicators may not work this time. So we're not trading these things, folks. We are maintaining our long-term perspective. If the market gets rough this year, I'm going to come back and talk to you about what you own in those portfolios, why the market is one of those things that does well ultimately after a stressful period. And so if we have some stress in 2016, and it doesn't turn out to be a great year, that is perfectly okay, because that will set the stage for better years going forward. And if we have a good 2016, that's perfectly okay too. My job with these, or my goal with these charts, is to set your expectations in the near term, help you understand them to the extent that they are understandable, because the market can do some crazy things, of course. And then go about your business, enjoy your lives, and if you're our clients, let us worry about the markets. Thank you, folks, as always, for watching and listening, and of course, I'll be back soon. Tomorrow is the jobs number, so take care. Thanks.